So what's going on, guys? This is part two of how I choose to invest in companies. And I wanted to dig a little deeper. I told you guys that I wanted to go a little deeper into how I actually, look at these companies. Not necessarily so much from a technical standpoint of, I'm not going to go through like financial stuff, financial information right now. Though, that is a big part of it. Financials is a big part of how I look at companies, especially when you're talking about true future companies that I like to invest in, which are three years out. Could be 5, could be 10, could be 15, could be 20. So I do look at financials heavily, especially on those kind of companies, because I need an understanding of how this company plans to grow. If they already are growing, they don't necessarily need to be making a profit, but they somewhat have to be getting closer and every year progressing towards reaching a profit. And I need a good jockey that's leading my horse. So I look at the CEO, CFO, board of directors. I need an idea of who's running this company, what's their background, and do I see them as a good fit for the future of leading this company towards profitability and possibly, 5xing, 10xing my money. And so I generally have about 5 rules that I go by, and I always go by, actually. These rules never leave. I'm always, sticking to these rules. They are always incorporated in my investing decisions. And the first one is, out of the 20 companies that you come across or that you're interested in, you need to be able to say no to 19 of them. You need to find, whoever the leader is within that market, the one who has the best opportunity to take your portfolio far. For instance, the EV market, the electronic vehicle market. I love that market. I love that space. I think it's going to be huge in the future, but I can't throw my money into every company that decides to make an electric vehicle. I have to pick and choose. I have to figure out which one is going to be the leader that I believe in the future. The one who is going to establish the biggest foothold, in the marketplace. And I have to ride that company. So when I invest, I'm always looking for the leaders in that particular market that I'm looking to invest in. So I believe Tesla is going to be a leader. I believe NIO out of China is going to be a leader. They sell the most electric vehicle cars in China. I believe they're going to be a leader. I believe that from a luxury standpoint, that Lucid Motors might be a leader. They all have their niche area. So when I look at investing, I'm looking at investing in those 3 because they have an advantage against most of the other companies. Besides Lucid, they haven't really produced anything yet, but they're planning on producing something, I believe, in April. But Tesla's been producing electric vehicle cars. So they're already so much further ahead of the competition. They're moving on to other things while their competition is just looking to make their first cars, or looking to sell their first batch of cars. NIO has taken over in China. It's the leader in China, and it's backed by the government, the Chinese government. So there's incentives for me to want to invest in those companies. I believe those companies are going to be the leader. You may believe, that other companies may win, but that's the great thing about it. We all have a choice, and we just hope that our decision is the right one. And we can make those right decisions by looking at financials. You're talking about Tesla, who's, damn near having 4 or 5 quarters of profitability, while most EV companies, they haven't turned a profit yet. So it's already leading in so many areas. NIO's leading in so many areas. I believe that Lucid's going to be a leader. But this is just an example of when I bet on the jockey and the horse. I love Elon, great leader. I love NIO's leader. He's about business. He doesn't joke around. He's not in it for the games. He's looking to push this world to a more efficient environment, a cleaner environment, and he looks up to Elon and he challenges Elon. And I think that's great. Competition is great as long as it's healthy. So yeah, that's the first, rule for me when I'm looking to invest. Number two is the number of shares that we own is more important than the price that we got in with. So what I mean by that is I tend to focus more on, how many shares of this company can I own? Well, that first needs to start with how much money do I have to invest at the moment? How much money am I investing with at the moment, and how many shares of this company is it going to buy me? Though I wouldn't advise throwing all your money into one particular stock in one single moment. I rather you dollar cost average to where you put some money in, you see how the stock behaves, you see how it fluctuates, and then maybe later down the road, maybe there's a pullback with that particular stock, then you put more money in. So it's dollar cost averaging, you're trying to bring your average down. Sometimes you can bring it down and sometimes it's up, so you're averaging up. Sometimes it doesn't pull back and the company's stock is continuing to rise, and so you may put a little bit more in. It may bring your average cost up a little bit, but it doesn't matter. If you're long-term holding, the particular price that you get in shouldn't matter as much because you're holding for long. It's different if you're day trading or you're swing trading. You're more price sensitive. You're trying to really get in at a particular price because you're looking to make a particular amount of money back in a quicker amount of time. So you're more price sensitive when you're day trading or swing trading versus long-term investing, to where you're still price sensitive, but the threshold is a little different. You're more inclined to say, I can buy at an all-time high for Tesla because I believe Tesla is going to continuously increase. So I'm not so much worried about where I buy into Tesla. I just understand that I need to own more shares. I'm more focused on building out my position within the company versus the price I got in. So the game is a game of shares. The more shares you own, that's why I believe you should put your money into a few particular companies instead of spreading it all out. Put it in a few concentrated, a couple of companies, and try to build out your position. Try to, get a lot of shares of those particular businesses, dollar cost average or average up with those particular businesses, and build out a position. So when that company takes off, your returns are going to be a lot larger than saying owning 2 shares of this company, owning 2 shares of that company, owning 2 shares of that. So if you make 100% return on a share, on 2 shares, say the shares were $10, you got $20 worth of shares, you make 100% return, you're only looking at $40 versus having 100 shares. Then you're seeing a lot more on your return. So it's a game of shares. You want to try to focus on building out your position within these companies. And number 3, when I started talking on number 2, it kind of ran me into number 3. But number 3 is focus on a few concentrated quality companies instead of focusing on having 35 companies in your portfolio. So this goes back to, 1 and 2 a little bit, to where you want to focus on the winners. I want to focus on the industry leaders, and I may be only picking 2 companies to ride within that industry. I don't need to invest in 10 companies within the same market. I only want to invest in the leaders within that market. I only want to invest into the top 2 or 3. So top 2 or 3 to EV, top 2 or 3 of fintech industry, top 2 or 3 of the supply chain industry. So you want to invest in the leaders. You want to have a more concentrated portfolio. You don't want your portfolio to be spread too thin, because it's also harder to manage 35, 40, 50 companies within your portfolio. It's hard to manage all that. You want to have your focus on a few particular winners that are really gonna push your portfolio. It's really gonna give you massive gains. So that's how I go about it. I don't try to put a few dollars here, a few dollars there. I'm not gonna see much return on that. So it just doesn't make sense for me to invest in that kind of way. I want to focus on investing in a few companies, few concentrated quality companies, and growing out my position within those companies, making sure I'm adding shares to the amount that I want. I want to have at least 125 shares of each of these concentrated quality companies, so I could really see some really decent gains if those companies, start to pump. And when I invest in a company, I'm looking for, at least 20% return. At least 20% return. Granted, I really want more of that 10x type of money, or that 30x type of money, but I at least would like I would at least like 20% return on my money with these type of companies that I'm choosing to invest in. That is how I always invest when it comes to selecting a company based off of the type of returns that I expect from them. Number 4, to how I pick my companies to invest in, is not to allow media and other influencers make investing decisions for you. Now, it's easy to jump on the wave of some stock that's pumping or some company that's pumping. It's easy to do that. You look at GameStop right now. Everybody wants to partake in this. Everybody wants to see their portfolio pop. You're talking about stocks that are going up 400% in a matter of days, or Dogecoin has, gone up over 1,000%, so you want to see your bag pump, and it's easy to get trapped in these type of companies. It's easy to get lured in by people that you see on YouTube that are constantly pushing, I made this off of Dogecoin, I made this off of GameStop, or AMC or BlackBerry, so you guys can make that too. So you get excited. It's like, oh, I can really see those kind of returns. You mean to tell me a guy made $1.2 million off of GameStop? So it's easy to get caught up in this kind of stuff. The trends, people watch, CNBC to where they talk about a stock company, and then all of a sudden you go on the brokerage firm and you see that stock is pumping just because it was mentioned on TV. Don't fall into those kind of traps, because those traps are gonna get you caught up into losing money. You're gonna be chasing the dollar. If you're in the stock before it starts pumping, that's great. Make sure you take out your profit, or at least take out your initial investment and leave the rest as house money. At least you have your initial investment, or put a stop loss or a trailing stop order to minimize the amount that you lose. But if you're jumping into a stock while it's pumping, that's very risky, because when you put your money in, that stock can pull back right away and you're left holding the bag, and that stock may never reach those numbers again. Or if it does, it may take forever to reach those numbers again, or what it was once pumping at. So if you miss a stock pumping, you miss it. So what? Move on. There's plenty of opportunities to make money in the stock market. There always will be opportunities. Don't get caught up in, FOMO, the fear of missing out. You don't want to get caught up in that, because that's gonna really put you in situations where you're gonna lose money. You're gonna be left with, zero returns, a negative portfolio. So try your hardest and just watch from the sideline. With this GameStop, all this crazy hysteria stuff going on in this market right now, I just been watching from the side, because it's not how I invest. I have principles, and I want to stick to those principles, because those principles are tried and true, and they have made me money. Now, if I start making decisions based off of how others are operating or how others are reacting, that's putting my portfolio at risk, higher risk than I want it to be at. So make sure when you're investing in a company, it's from your own due diligence. It's from you looking at the financial statements. It's from you looking at their balance sheet. It's from you doing your due diligence on the CEO or the CFO or the board of directors. It's not from other people telling you that you should be getting in this play with them. Or it should not be from CNBC talking about a particular stock and all of a sudden the stock is blowing up. Be aware of that and stay away from that, because I want to save you guys from heartache and losing money. And, you know, I'm trying to save pockets over here. And number 5, I mentioned this before in the part 1 video of how I invest in companies, but it's to treat trading like a business and not a game. This isn't a game. I get people in my DMs all the time asking me about, you know, how should they invest? How do I get started? This isn't a game. I give them almost like a warning, like, this isn't a game. Know that you can really lose money in this if you don't know what you're doing. Before I even started investing, I was in college learning about investing. I spent 2 years learning about the stock market before I had ever invested my first dollar. So I often tell people they should read a particular book, A Simple Path to Wealth by J.L. Collins. Great book it's for beginning investing, about how you should be investing. It's a little more safer type investing, to where you're investing in Vanguards and stuff like that, ETFs and stuff like that. But it's great for beginners, so you can understand the market. I don't want to ever give people, oh, well, you can do this, just go ahead, buy this, buy that, buy that. I hate giving people the companies that I'm investing in, because I don't want to be responsible for you losing money. It's all good when you're gaining money, but when you're losing money, people tend to want to put blame on you. Man, you told me this was a good stock. Man, you told me I should invest here. So I don't ever want to be blamed for somebody losing money. I'm not a financial advisor. I didn't go to school for finance. I went to school for supply chain management, something totally different. So I don't want to be responsible for people losing the money. So I try to tell people, this is what I like. These are the companies I like and the reasons why I like them. But I don't advise you to invest in them because I'm investing in them. I want you to do your own homework, do your own due diligence. Make that decision because you did the homework. Don't make that decision because I told you to make that decision, or I led you in a way to make that decision. So this is not a game. Money can be made, but money can be lost. And last year, a kid committed suicide because he saw his portfolio. I can't remember how much he lost. Maybe about $700,000 or something like that. His portfolio was showing that he was losing that much money, but in actuality, he wasn't. But he ended up committing suicide. So this isn't a game. This is real life. And I treat it like a business. I treat it as if I'm a company and I'm acquiring other businesses. You're an owner of these businesses when you buy its stock. So it would be very irresponsible of you not to do your homework on these companies, because these companies potentially have the ability to either make you money or lose money for you. So you want to take this serious, and you in order to really see money in this game, to see money in this market, you have to take it serious. If you're playing this as a game, you're better off just going to a casino, because that's what you're essentially doing. You're gambling money. You're throwing money in hopes of winning. When I invest, it's more calculated. It's still a risk nonetheless, but it's a calculated risk. I've done my homework, and based off of my homework, I believe the odds that this stock is gonna go XYZ versus losing me money. So treat this like real life. Treat this like you owning a business, because essentially you are owning part of a business, and treat it like you are a business. You know, you wouldn't acquire businesses that are gonna hurt your business's bottom line. You want to acquire companies that are gonna increase your profit margins or increase your profitability. So treat it that way. But yeah, that's really much all I have for you guys today. Another good video. I might bring some more stock videos on, you know, how to know when to cut your losses. Because I think that's a subject a lot of people don't talk about, and a lot of people don't know when to get out of something. They may hold on to it for too long to where they see their profits completely wipe away, or they end up in the negative. So I may be making a video on how to cut your losses, and or how to, you know, take profit and leave, or either take profit and leave some money in, or take your initial investment and leave your profit in, because that's house money. If you lose all that money, oh well, I didn't lose my initial investment. But yeah, I thank you guys for checking out this video, and I'm gonna have more on the way. I'll see you guys in the next one. I'm out.